Today, we will talk about how debt financing works, examples, costs, pros, and cons. Let's learn about debt financing. Debt financing happens when a company needs money and decides to sell debt instruments to individuals and/or institutional investors. In return for lending the money, the individuals or institutions become creditors and receive a promise that the principal and interest on the debt will be repaid. Debt financing is the opposite of equity financing, which entails issuing stock to raise money. When a company chooses debt financing, it sells fixed income products, such as bonds, bills, or notes, to investors to obtain the capital needed to grow and expand its operations. If the company goes bankrupt, lenders have a higher claim on any liquidated assets than shareholders. The cost of debt is the interest payment to bondholders. A company's investment decisions relating to new projects and operations should always generate returns greater than the cost of capital. If a company's returns on its capital expenditures are below its cost of capital, the firm is not generating positive earnings for its investors. One metric used to measure and compare how much of a company's capital is being financed with debt financing is the debt-to-equity ratio. In general, a low D/E ratio is preferable to a high one, although certain industries have a higher tolerance for debt than others. Debt financing often requires the borrower to adhere to certain rules regarding financial performance. These rules are referred to as covenants. Another advantage to debt financing is that the interest on the debt is tax-deductible. Still, adding too much debt can increase the cost of capital, which reduces the present value of the company. The main difference between debt and equity financing is that equity financing provides extra working capital with no repayment obligation. Most companies use a combination of debt and equity financing. One advantage of debt financing is that it allows a business to leverage a small amount of money into a much larger sum, enabling more rapid growth than might otherwise be possible. The main disadvantage of debt financing is that interest must be paid to lenders, which means that the amount paid will exceed the amount borrowed. Debt financing includes bank loans, loans from family and friends, government-backed loans, such as SBA loans, lines of credit, credit cards, mortgages, and equipment loans. Debt financing can be in the form of installment loans, revolving loans, and cash flow loans. Debt financing can be both good and bad. If a company can use debt to stimulate growth, it is a good option. However, the company must be sure that it can meet its obligations regarding payments to creditors. Here are two key takeaways. 1. Debt financing occurs when a company raises money by selling debt instruments to investors. 2. Debt financing is the opposite of equity financing, which entails issuing stock to raise money. Hope this would help. Thanks for watching.